Let's talk about the primary market action then. India's largest pure play green financing NBFC, IREDA's IPO has opened up for subscription today. Remember, this is the first PSU IPO in the last 18 months since the LIC public issue in May 2020 itself. May 2022, that is. Pradeep Kumar Das, who's the chairman and managing director of the company, now joins in to discuss the issue. The issue opens today for the next couple of days. The company is looking to raise about 2,150 odd crores, and nearly half of that, close to 1,300 crores, will be the fresh issue. Thanks a lot, Mr. Das, for joining in. Before we talk about your numbers, etc., I was looking at your comparison with peers like REC and PFC. In that, your spreads and your credit risk-weighted asset, along with your PCR, or provision coverage ratio, have been lower than the peers. Can you tell us what explains that?
Yeah, let me confirm what you have seen. It is correct, except that they are not exactly peer to us. If you see our book size, and 77% is towards private sectors, vis-a-vis they have around 10% towards private sectors. And ours is 100% green finance. Theirs is as on that, even if you see it is 8 to 10% in the range towards renewable finance. So that is a major difference. And since our generation assets where we have finance, almost 80% are commissioned, so which requires lesser provisioning. So by and large, once the renewable projects are commissioned and the testing time of techno-commercial parameter what we have envisaged during appraisal stage, typical in case of wind solar for 1 year and for hydro 1.5 years, once it is confirmed, the project is largely de-risked. So the provisioning requirement is less. So therefore, comparing with PFC and REC, exactly IREDA will be unfair.
Okay, all right. Size of the book as well is different, but as you make that valid point that private is 77% of your book, while for both those two comparisons, both those two peers, it's less than 10%. Got that, Mr. Das, and thanks so much for speaking to us here on CNBC TV 18. Let's focus on a couple of other points. Your borrowing mix, if I look at it, bulk of it comes from the banks. So there is that risk in terms of your NIMs. Could you tell us how do you manage this, and what could be the rough guidance if you look at the spreads and the NIMs as well from year on?
See, if you see, till March, we are AA plus. And 6 months back, we have been upgraded to AAA stable. Larger part of our borrowings were earlier. So, and if you see during COVID period of 2 years and last 3 years total, we have fairly drawn from the domestic market at the most competitive rates. Banks, that is largely 3 to 5 years of true fixed loans. And the NIM has come down. The reason is, during COVID period, we wanted to support the developers by reducing the interest rates fairly so that the sector could sustain. And today, we are quite comfortable. And our NIM has already gone incremental. From July onwards, we have enhanced the incremental interest rates. And that additional NIM incremental will be reflected soon in our next quarter result.
So what is the NIM likely to be? Around 3.36% is what it is at currently. Can we see it inch towards 3.5%? And more importantly, at what level does it sustain?
See, generally we will prefer 3.5 to 4, not much, because renewable sector in particular, if when you are having commissioned assets are de-risked, so your NIM has to go down because your PCR also will go down. Ultimately, the bottom line will improve. And as an investor, one will look at the end of the day, what is the PAT and cash flow to the company. And we have fairly 10 plus years of balance cash inflow, whatever loan we have financed.
Got it. Mr. Das, as you mentioned, a couple of rating agencies have upgraded your rating, which is good. And, we take that point on board. Our ticker team as well is carrying that out. But Brickwork Ratings, they had mentioned a note that you all haven't responded to them. What happened? Why you all didn't respond to them?
See, there was some issue with respect to the rating agency Brickwork itself. So therefore, we have not gone with the further rating with them. So we have India Rating as well as ICRA and Acuité.
Okay.
All right. And there have also been some other run-ins as well, because I read that, perhaps you've not been in compliance with the international lines of credit under their financing documents, including Asian Development Bank, in relation to maintaining the GNPA loan level. Just wanted to understand that aspect of your business as well. Is there any regulatory risk here?
No, not exactly. Let me clarify. Since 1997, we are having a relationship with ADB, and post that with you name any global level players like World Bank, JICA, ADB, KFD, etc. And we are having fair amount of mature relationship with them. They have handholded us also to develop the sector, which is now established RE sector, which was emerging then. And yes, in March 20, our GNPA had gone up to double digit, and net NPA has gone up to 7.18. But if you see the March result of 2023, the GNPA has come down to around 3 plus, and the net NPA has come down to 1.66, which is further reduced in September to 1.65.
Okay. Is there further scope? So no worries on asset quality is what you're trying to tell us, right?
In fact, our asset quality has been quite improved a lot. That has resulted reduction in PCR.
Yes. Yes. So and will it improve from here? What is your, if you post this fundraise, what will your capital adequacy ratio be post this fundraise? If you could give us that number.
Yeah. See, typically, as per RBI, we need to have 15% CRAR. But that is a bare minimum. But ideally, to maintain a AAA stable rating, we will prefer to keep around 17. And any point of time, we will prefer to go to 7 times of leveraging. If you see our March gearing ratio, it was 6.7, and which is come up to now around 20. CRAR has come up to now 20 against 18 in March. So post IPO, it will further improve. But we have quite a lot of sanction under process, project under process, and if you see our annual disbursement, last year we had 21,000 crore plus. This year we have already gone sanctions 7,400 and disbursement 7,400. Typically our larger part of sanction and disbursement happens third quarter and mostly in fourth quarter. So once we approach towards the end, not only will be utilizing this equity, but this equity, additional equity of 1290, if we get 32, which we are very much confident, and 7 times we can leverage that, and we can go for further lending and further borrowing also. And I'm sure the way we have enhanced the business in last 3 years, which includes the worst period of COVID period, we are confident in the time to come we will further also grow. And if I tell you the exact difference, company is 36-year-old company. In 33 years, we had done a business size of 23 to 24,000 crore loan book. And in just 3 years, we have added 24,000 crore loan book. So that speaks in which we have grown. And at the same time,
Right. So before we let you go, just give us 3 important numbers going forward, right? One is at what rate can your loan book grow over the next 3-4 years, since you've seen a massive surge in the last 3 years itself? Secondly, what could your annualized slippage be? And thirdly, what could your credit cost be going forward?
See, if you see last 3 years, CAGRs, our loan book has grown at 30%. Our sanction has grown at 72%. And our disbursement has grown at 56%. And the PAT has grown at 58%. Since we have started with a small base, so percentage is on the higher side. But as we grow more, the volume-wise will continue to grow, we are growing. And but percentage, it may slightly come down. But if you look at the kind of demand what we are envisaged till 2030, keeping in mind Honorable Prime Minister's commitment in COP, as well as this assignment to every citizen of India to meet that target of 500 gigawatt installed capacity by 2030, will be requiring around 30 lakh to 32 lakhs crores of investment in India in RE market. And out of that, around 25% equity and 75% debt, if you take, 24 lakh crore will be required. Half of it will be coming in general from NBFC market. As on date, our share in NBFC space in RE finance is around 31%. And since we are a 36-year-old company and working only in this sphere and having complete expertise and dominance, you can say, and we are one of the most preferred lender in this space, typically during construction period and all. So we are quite confident we'll be fully leveraging to our net worth and net worth fund, In addition to the equity, we may have to resort to PDI, that is perpetual debt, and sub-debt in order to ensure that the net worth fund is kept at a high. And apart from that, we also envisage that big ticket projects like offshore wind, green hydrogen and its derivatives are future new and emerging sources, where we will not only be requiring big ticket project, but also the construction period will be little larger. So what we have already lined up with other agencies like 4 banks, we have signed MOU, Bank of India, Bank of Baroda, Bank of Maharashtra and Union Bank. And we signed with Bank of India almost a year back. Post signing, we have taken a one largest
Yes.
in fact size project 4,444, that is of SJVN. And essentially these are the agencies, those who used to go to direct to the market, but they have seen our competency where we
Yes.
could establish that the transaction cost, what is they are going to incur, that is going to cheaper through us. And in the time
it.
to come, we will be doing the joint lending. Through that joint lending, in addition to our fully leveraging, we will be earning fees-based income, which will be directly contributing to our bottom line.
Lovely. All right, Mr. Das, we thank you for joining in. Appreciate it. Wishing you and your team all the best with regard to this issue. And on listing, we re-invite you to join us and give us more concrete numbers in terms of your vision for the company for the next few years. Wishing you and your team all the best. Well, for the time being, we'll slip into a short break. Come back. Continue.
Hey, thank you for watching this on CNBC TV 18. Hope you liked it. For more such interesting news and updates, follow CNBC TV 18 on all the social media platforms.